Fear, greed, and loathing in the multifamily market. While buyers were starting to enter the space just several weeks ago, including Blackstone making an historic acquisition, or at least proposing, of Air Communities, $10 billion REIT acquisition taking private. Cold water's been thrown on the industry as rates have spiked in conflict in the Middle East. Fuels uncertainty and volatility in the markets as we see equity moving to the sidelines where operators are seeing an absolute incredible window of opportunity. So much is moving around in the multifamily market, in commercial real estate, and the economy. Thank you for joining us on the Gray Report. If you're an active investor or passive, fortunately, you are in the right spot because we are breaking down all of the latest research reports, data, and throwing out some original insights and opinions you're not going to find anywhere else. Basically speaking the truth, no double speak, also not pulling punches. Do not care about who we're going to offend or trying to, keep that line and that narrative. Just trying to give you the real facts of what's going on and what we actually are seeing in the market as we are in it every single day. Incredible amount of reports we want to get over today. Make sure you've liked this video and subscribe to the Gray Capital YouTube channel so you can stay up to date and be ahead of the competition. I'm joined once again, as always, by Dr. Matt Bosnagel, our Director of Communications and Marketing here at Gray Capital. Let's get into it. Welcome back to the report.
Hello,
Matt. How we doing?
pretty good. This has been a really interesting week. We were just talking before, and you were talking about how this past couple of weeks kind of blended together a little bit. But man, it is a story of contrasts.
Oh my gosh.
And shifts, some big shifts.
Well, just last week, man, and I think the week before, we were saying, as buyers have been coming back into the market with a little bit more confidence with this idea that, okay, cap rates may have topped, prices have bottomed. Blackstone making a major announcement, buying, $10 billion of multifamily assets. We've got a bid in the market. All that is good news. Then rates started running. Volatility has increased. And then, we have serious conflict in the Middle East that is going to continue to affect energy prices. We have strong inflation prints that we're going to parse through that may or not even really actually be accurate. But regardless of, whether they're actually reflecting real growth in the economy or not, it's certainly being perceived as the market as higher inflation. And that is driving markets. Matt, we closed on a huge piece of real estate yesterday in this crazy market. We completed our acquisition of 444 units down in Evansville, Indiana. Beautiful asset, River Club Apartments. Man, navigating the waters of capital markets the last several weeks as we're attempting to rate lock it was turbulent to say the least. We have an incredible team, so we were able to execute it. We were able to get close, still at a good rate. But Matt, there's deals right now that I know of that, we're also bidding on where buyers they're blowing out because of the volatility. Institutional capital that has started to come back in, they're now taking another pause. And so I think that we may have an opportunity, a small additional window. Someone's propping that window open maybe for another month or two. Because as we're going to talk about CPI and inflation, I think the headlines are a little bit different from the reality. And shelter is driving inflation, or at least the headline numbers. And we cover shelter. We should cover residential real estate. We cover multifamily real estate, once a week for, an hour or two live. You spend hours a week, researching, finding the latest data, disseminating to their team and people who are on the newsletter for the Gray Report newsletter. We send two newsletters every week. You can sign up, graycapitalllc.com/newsletter. I say all that just because we are very close to the market and we've got a pulse. Our ears to the ground constantly. We know where rents have been, where they are today, and a decent idea maybe where they might go in the future. And what we see in the statistics that the Bureau of Labor and Statistics puts out compared to the reality of what we know is happening is they're not the same. They're using different numbers. And when you actually strip that bogus number out, I'm just going to call it bogus, you actually get inflation down closer to 2%. And so, but the market is taking the headline at face value. So you put together some really good reports and some really great tools we're going to look at. synthesize this for us, Matt, what was your impression? Compare last week to this week. Where are we?
It really is like this great strength of the apartment market was shown last week, and that has come crashing into the cold reality of interest rates staying high for the time being, for maybe longer. Higher for longer has been real since 2023, and it's still going to be even more real, I think, now. Whereas before, maybe people were banking on the imminent rate cut for now. There's even a question, maybe it's not going to happen. Maybe we don't even know when. Whereas before, people were like, oh yeah, it's coming. It's coming. It's going to come in July or even September. Doesn't matter. But now it is a big question. Like, we don't even know when it's going to happen. There were predictions, some people were throwing out March. Some people were saying we need a rate cut increase. It has become a lot more uncertain, even I think, than it was in 2023 when we were like in the depths of it.
Yeah.
Now it's like, wow, we don't even know what's going to happen.
The uncertainty breeds volatility, which leads to lack of action.
Yeah.
Especially at the institutional level. And again, we talked about this a lot of time, trying to transact and close on an asset when things are moving around. You don't know what your cost of capital is going to be is incredibly, it's perilous and it's challenging. And it brings a lot of folks out of the market because you can't predict. You don't know where things are going to be in a couple of months.
And that's what I think what was interesting, what you said about the kind of paradigm that we're in. It's not necessarily the operators or syndicators that are less confident about the market. It is the equity that's like, oh man, well, I see these interest rates. The wealthy dentist or the wealthy institution is like, I don't know, man, these interest rates are pretty high. So I think that we're going to sit it out. And it makes me feel a little more confident because it's like, well, that's a job that I can do. We can educate, we can get those people and kind of convince them of what we are already convinced of. Whereas if it was a bunch of competition, then that's like, all right, our opportunity is gone. I think that this represents, if you can get this equity on board, a real opportunity for people. The window has been propped open.
Yeah.
And that's a little bit of a best case scenario or optimistic way of looking at it. But it definitely is the reality right now, because I don't think things are headed toward crash or some kind of stagflation or anything. It is this bumpy road, but this interest rates has become such a big such a big factor in a way.
It's analysis paralysis. People are spending so much time trying to figure out where it's going that they can't come to a conclusion to make a decision.
Yeah.
And so it's absolutely fascinating. I think it is true though. I see it as like a fog of war. It's like, the first shot has been fired, the smoke has gone off and you can't really see who's, where is where. And that creates a difficult environment, but it also allows you to navigate, kind of undetected and sneak up and acquire some assets that you otherwise would at prices that you otherwise would not have been able to do. And I'm starting to see these opportunities where they're just surprisingly not that many buyers. Where just a couple weeks ago there were, and a year or two ago there would have been a line out the door bidding the thing up over and over and over and over, and all of a sudden the basis is attractive, the cash flow is attractive, but you have to buy it. The reality is you have to buy it at a price where you have room for those swings.
Yeah,
because that uncertainty is real, and maybe you can get you can assume a loan, so maybe there's a little bit of less uncertainty, but even with that. There's still some question marks, and putting new debt where it is today versus where it's going to be, and rates could be lower in 3 months. It works out, or it could be the 10-year could be at 5% again. We were looking at probability charts, Matt, for SOFR futures, and I mean, this September, rate cut is most likely not going to happen.
Yeah.
And
what's your call?
My hot take is, and so this is not based on any type of data where I know where the economy is going.
Well, neither is the Federal Reserve's.
Exactly. None of it is. So it's like, let's strip all of that. And I'm just trying to understand kind of how the Federal Reserve works. And they like working in round numbers. They know that inflation has come down. They know that, shelter component of CPI, which they have to address, is elevated. But I think they're trying to do a little bit of a double take here. They made the mistake, I think, in November of saying, we're going to be looking at rate cuts. Now they need to throw cold water on that idea. And because people started making bids and getting back in the market
based on the expectation,
based on their expectations. So now they have to, so they have got a good data point. CPI is high. I don't think we can cut rates anytime soon. We're not confident on the progress of inflation, But if you know anything about the way the numbers are made up, they actually have made a decent amount of progress. The shelter component doesn't make sense. Again, it's kind of bogus. It's not really helpful telling us where inflation is today. Because again, we know where rents were last year, Matt.
Yeah.
We know where rents are today. They're still, they're starting to grow, but there was a whole year and a half of like negative growth across the country that never has shown up, has never been absorbed.
Yeah.
So, they're saying they're trying to break the backs of hope of investors. And so they need to keep us in this restrictive territory, or at least make us think that we're going to be in this environment for a much longer period of time. So again, rough math having nothing to do with actual inflation or anything other than kind of know that it's not as bad as the headline is. Round numbers. Okay, a year of keeping Fed funds at five and a quarter. It's going to be 12 months, I think, in July and September. At that decision. That's not that far away, Matt.
Yeah, I know.
And that's going to be too soon. So in my mind, I'm taking that off the table. I think it's January. January is 18 months.
Pretty nice round.
It's a round number.
Yeah.
And it will so disappoint the investor class that it's not going to happen in 2024. But at the same time, it's not so long that I believe it'll break the back of the economy. They're trying to thread the needle right between the two. They don't want to break the economy. They want to achieve this soft landing. They like the idea that wages are growing, that unemployment is low. They need to get price controls in check. And so they need to make sure that it's tamped down enough. And so I'm thinking January, and I don't think it's going to be a big cut. We've got a lot of time to see how that's going to look, but I'm putting January at the earliest.
Okay.
I think rates are coming down, but it's just not anytime soon. And I don't think they're coming down to where they were a couple of years ago. Because we are going to see higher inflation than we saw in the last decade. We see rents are already picking up. Wages are picking up.
Very true.
I think, productivity is increasing. Manufacturing is increasing. AI is going to make us more productive. That's really good for the economy. Productivity is good. I'm not worried about AI. So I think we have a really good setup. But in order to achieve that, Federal Reserve has to psych us out and make us think that rates are going to go up, that they may hike, getting that idea of a cut just out of our heads. Just don't think about that. Don't plan on that.
Don't even expect anything. Yeah. No, I agree.
And so that was, again, not data driven other than round numbers Federal Reserve likes to use and knowing a little bit of where inflation may actually be. And then I was like, well, then you were like, hey, we've got this great tool the CME group put out. Can I share that real quick?
Yeah, let's look at the real hard numbers for these. This is based on futures markets.
And so in the futures, so the futures market is often wrong. So again, take this with a grain of salt. But we're just looking at probabilities. It's a data point, right? So this is the probabilities comparing, basically what probabilities of rate cuts in the range would be at the September meeting.
Okay,
so this is where current, we're at 5% to 500 to 525 basis points.
So 45% people think we're going to roughly stay the same.
Yeah, probability is pointing to about a little less than 50% going to stay right where we're at. Okay, and that has basically kind of stayed the same over the last several months. Although I guess March, people were thinking it was maybe even less, but people were thinking that we were going to see a rate cut.
Yep.
So let's look at that rate cut. Back in March, actually people thought it was a 42% chance that we were going to see a cut. But now today, only 20% probability at the September meeting. And in fact, there's actually a 32% chance of a rate hike of 5.25 to 550, 25 basis points. That's pretty crazy. So in my mind, again, looking at the data, again, this is probabilities or futures. Things could change in a second. We're staying where we are in September.
Can a man dream? Can you click on June and see? Well, let's just see what people think about June. Because once upon a time, people were thinking that. People were thinking that.
I don't think there's a. Well, let's see. I don't think there's a meeting in June. But so basically, it's a current 83% chance that it stays the same.
Yeah,
and only a 16% chance that it would come down. But it was 55% chance back in March. That's how far things have changed in a month, Matt.
Yeah.
So let's fast forward. Let's go to this. Let's go to January. This is where we're seeing the spreads and again, this is far out. Who can predict the future? This
Mhm.
this model can't predict the future. Again, I put more faith in just
Yeah.
in my throwing a dart at the wall, and again, using round numbers that I like, the Fed likes to use. But only a 10% probability that we'll stay where we are, and there's basically no probability that it would increase. Sorry, no, yeah, this is current, so there's no really probability it's going to increase much. Um, sorry, my mistake. There's a 10% chance of a hike
Okay.
in January, 29% chance that we're going to stay current at the 500 to 525.
Mm-hmm.
30% chance, which is the plurality, it's the most likely of all of these potential outcomes, that we'll see a 25 basis decline in rates. But then there's even calls, a 20% chance that we get a 50-point range. We're going to be in 450 to 475. 20% versus a 10% hike, it's starting to look better. And even some further hikes that are even less probable than that. So, this is looking out, in the next couple months, and this is what, the most likely probabilities are. And so they still have a 25 basis point cut in September, and then another 25 basis point cut in January. And then they're also saying there's going to be another 25 basis point cut in June. I think this January one's going to happen. I don't think the September one is going to happen.
I think
this is so, and again,
maybe.
This is SOFR, and SOFR and the Fed funds rate obviously pretty much move in close to lockstep. This is the SOFR fixins. And so, we saw we leaped up. And, basically there's, this is September, they think it could come down a little bit. Again, I just don't think it's going to happen. I think it's going to be January, man.
An election year, baby. They got to juice those numbers. Where's your conspiracy brain?
I think honestly that's the strongest argument for there to be rate cuts prior. But I think that the Federal Reserve, Matt, is so caught up in its own image that I think that, as much as I've heard it say so often, like, just wait before the election, and that could happen.
Yeah.
I mean, that September cut certainly would be lining up, and again, from what we've said, there's an argument that they could. But I think that they are looking at their long-term legacy and the economy, and just credibility in general. Their credibility is at hand. Believe me, I'm the first one to be able to talk about a conspiracy theory, but I don't think that's going to be I think that if you're just so confident that they're actually going to cut rates before the election, make a trade on that, go see how it works out, because that's what everyone thinks is going to happen. And so I don't think that's actually what's going to happen.
Yeah, well, and they also love to imagine themselves as a hawk. They probably,
and well, this whole idea that, everything's connected and there is a conspiracy, and Jay Powell and Biden, and I'm not saying that there isn't a lot of things that could criticize about the presidency and the Federal Reserve. Like, the list is quite long, but let's just kind of take some of our emotion and bias out of it a little bit, and just let's just be real for a second. That certainly would go towards a certain narrative, but let's not get caught up too much in the political narrative.
Yeah. Well, and there, there's also, I think you alluded to it a little bit. There's also a personality to the Fed, whereas I think, and it's shown, they want to kind of scare people. They want to be the hawks a little bit more than the dove.
Right
Hawks,
now, because they're not going to get any credit right now when inflation is top of mind.
Yeah.
And it's your mandate, get it under control.
And that's what kind of surprised me too. And if you want to start talking a little bit about the comments that Jerome Powell has recently made that really kind of kicked off this speculation.
Yeah, we should.
It's a little bit of a moot point, but
we should.
The Reuters headline, and we could, there's any number of articles about this. I picked the Reuters one I liked. They call it "Blunt Powell Signals Rate Cut Plans on Ice." It was blunt, it was direct, and it was a change of language. Whereas before he was like, it's a little uncertain, we need more data. Now it was like, yeah, things are running hotter, and I think that we may need to delay. Last week's hotter than expected CPI print, we were talking about, maybe they pay attention to its PCE. No, it must have had an effect, must have lit a fire under it.
Yeah, again, that's what the market's looking at. So, and who... did it light a fire under the Federal Reserve, really, or did it light a fire, in the markets? That's what moved is the market participants, and certainly the Fed is coming out with their language, signaling to markets that. But isn't again, that is, they don't have to do anything, but they can achieve their objectives of keeping things restrictive.
Yeah.
In the at rates that they don't directly control, like, treasuries, but if they can influence the market by throwing this cold water on it, it's gonna
Yeah.
help a lot because, before this period, treasuries were coming down quite a bit. So,
I think, I think this was a notable piece of news that came along, because nowhere before have we heard, either in the comments, that they have in the official meetings or wherever, they've never said that, hey, we're going to delay these rate cuts. It was always more data. We need more data. We're a ship in the storm, or whatever metaphor they want, nautical metaphor they're
now
having.
there's a lack of confidence in progress.
And now it's like, oh, we have made a conclusion. Before there was no conclusion.
Well, before it was, we still believe in our take that we're on the right path.
Yeah.
And, there's a couple of bumps in the road and, we need a couple more data points. And exactly to your point. Now they're saying, okay, we got the extra data points.
Mm-hmm.
These bumps are bumpy and we're losing confidence that we're making progress.
So clarity and that change of direction, I think, made this really, I think this made this newsworthy for sure.
I do. And I just, again, it's, watch what they say, not what they do.
Yeah.
And they know, because they're not being, I'm not saying they're not being honest, but it's not like every time Jerome Powell is coming out and saying, look, the shelter and CPI is BS. And if you actually look, if you strip it out, I mean, he touches around the edges of it sometimes.
Yeah, he beats around the bush.
But I don't hear him saying like, actually, we're at 2%. Actually, no, we have made progress because again, he doesn't want to do a victory lap when, they are arguably stalling out, and we are seeing some moderate growth. Again, it's not like inflation is going away. It's just, and what's wrong with being at 2.5%, percent inflation? I think that's okay, but they can't say that just yet.
And that was another thing too that makes this, not to repeat myself, but they have a responsibility to not be clear for a lot of their comments, because they don't want to get people thinking that it's a guarantee that there's going to be a rate cut. They have an enormous weight of responsibility where markets can move based on if they're unclear or overly clear about what they think they're going to do. And so by announcing like, hey, this is something of what we think, they're much more closer to a very unusual kind of communication from the Fed.
And if you think about it, it's really simple. If you knew that interest rates were going to come down, to make money off of that, the simplest way would be to buy bonds at the higher rate that they are today.
Yeah.
And then you sell them. They become more valuable because all of a sudden more people are buying the bonds, which means the price go up. More people buy something, drives the price up, which means the yield goes down. So, okay, rates are going to come down. Okay, I'm going to go into bonds, which ends up lowering the rates, ahead of time. Not what the Federal Reserve wants to do.
Yep.
And it's because and again, that's why they just have to mention it, and it has an effect of lowering the longer end of the curve, which the longer end of the curve had been coming down in anticipation of these rate cuts. They're saying a long end of the curve, since a lot of financing is, finance with, 10-year treasury, 5-year treasury, 7-year treasuries.
Yeah.
We need to get that end of the curve up a little bit. Let's get a little bit flatter. It was really inverted where we had, the shorter end, the Fed funds 2-year up here. And then, but the longer term stuff was down here. So you could still do deals. There was a spread. You could just figure out where the efficient part in the maturity, spread would be. Like, look, the 7-year is still pretty good. Not too long ago, we were just a little bit above 4. Sounds like a really good deal. Now we're, 4.5, 4.6.
Yeah.
People are talking about, you're going to talk about here in a second, maybe it'll 10-year will hit 5% again.
Yeah, maybe.
Maybe, but that's because people are saying, okay, maybe we're not going to see rates get cut anytime soon.
Yeah.
But now with the whole Middle East conflict, Israel and Iran, like overnight, rates dropped a bunch because a bunch of people flooded in to buy bonds.
Just to get the specifics on what Powell said.
Yeah, get the specifics.
He did. So the quote is, he said, "The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence." Again, big change in the message, notably clear. Inflation is higher than we want it to be, and it's going to take longer to get to those rate cuts. This is a little bit tangential to the topic, but I always wonder, last week after the CPI showed inflation hot, we did talk about how investors and financial reporters would be hanging on Powell's every word. And fortunately for Powell, he was going to the Wilson Center's Washington Forum on the Canadian economy. Where else? And he got the word out. But I also thought about other potential venues. And we can edit this out. Like, what if he was going through the drive-through at McDonald's and his quarter pounder was too expensive? Is he going to make an official statement there? What if, here's what I was also imagining. What if maybe Jerome Powell has a granddaughter and her best friend has a karaoke birthday party? I mean, the mic's there. He could make his announcement there.
Matt, as much as you were wondering if this was too off the rails, I don't think it is at all. It is actually, it's a good question. I mean, it's be curious, like this TMZ or anybody is following around Jerome Powell, because it's not, we only hear from him, when he's at these makes these very controlled remarks. They're all scheduled out. Okay, that we're gonna have a couple of weeks where we can talk about things, and there's a blackout period. And then we're waiting for the actual press conference. There's the only times we hear the words of Jerome Powell, but he does speak words to someone in between those times. Maybe it's just his family. Maybe it's just like the people that he works with at the Fed. But it's funny. Yeah, he does have to, participate in the economy in some way. Yeah. And obviously he's probably very measured and it's very controlled. But you don't see TMZ following around Jerome Powell saying, okay, he's buying a Gucci belt, or he's like, he's shopping at Walmart or something. I'm curious. I wonder, really one, if some people actually do. Yeah. Because not saying for myself or anything, but if you wanted to have it'd be information, I guess. Yeah. If it's important to listen to a couple remarks here that are very controlled, getting a couple, off mic and just, off the cuff remarks in the wild could have some information. Yeah. I don't know what, but somebody's crazy that thinks that there's money in it that, you send a private investigator to follow the, I'm not suggesting any of this. Just or TMZ or somebody. I don't know.
You know what I really thought is,
I think there's an agreement between the press.
Yeah. Oh yeah. That's true. Like the royal family kind of.
No, I mean, if anybody could do that, I mean, it's the golden rule, right? Who has the gold makes the rules, and who has the money printing machine backed by the all the nuclear bombs makes a lot of rules.
Oh man. Well, good. I'm glad we're tracking him.
We're gonna get a knock on the door.
Yeah, that's right. I was thinking about this. They must have a schedule for the Fed, for these Fed committee members. Like like every week, maybe they've got some little consortium, or or maybe not. It's maybe not the granddaughter's birthday party, but they've got some meeting, some official venue where if news pops off, they will have this little thing where they can go out and make a statement. But maybe
they don't make statements. They don't react to news, though.
No, I don't think they react to news. But if they want to get the word out and they don't want to have to wait until the next Fed meeting, or they want to call,
they have a way to leak something. Yeah. Do you think they have very much sequestered, closed, to let off steam? They got to have some release valve. They're so measured. Do you think that they have a venue? They go somewhere. They go out to. They go back out to Jekyll Island, or they have some secure facility that they can just let loose, and then it's a stereotypical. They get all hedonistic. And go wild to talk about how we're lowering rates next. We're just gonna lower it. They can just let it all out
because they're so measured.
Just being cathartic.
They need that too because they're so measured.
What's the term is 6 years for a Federal Reserve chairman, and it's been renewed. Yeah. So that's a long time to stay bottled up. You got to let that out at some point.
So true. Yeah.
Maybe.
They need that. I totally agree. Emotionally, psychologically, they got to have that.
I don't want to think about Janet Yellen letting loose, though. That's a horrible.
I think should be pretty fun.
I don't. Yeah, maybe. Maybe.
Yeah.
Maybe the wildest one. I don't know if I'd want to see that.
I mean, look at that. Look at the face of Jerome Powell. He's probably, he makes sure that you're going to have a good time tonight.
True.
And I hope that, he makes the same decisions about the economy, but we'll see.
Yeah, I don't know if he's going to let loose.
Yeah, it doesn't look like that face.
As I look, I think
freewheeling Jerome Powell. Yeah.
Yeah, exactly. Again, navigating this by the stars under cloudy skies, Matt.
And we're talking about these decisions of the Fed members when it's the 10-year Treasury. That's even wilder. That's the market, and I can't even begin to understand the motivations behind a public market determined metric like 10-year Treasury yields.
Now again in an environment that there are some concerning things happening in the world.
Mhm.
There have been for a while, and there kind of always are.
Yeah.
So but the whole this Israel-Iran thing is
Yeah.
something that, again, that impacts a rush to safety, whether that's
Mhm.
bonds, and U.S. treasuries are the best bonds and the safest bonds in the
Yeah.
world. Gold, it's silver, it's commodities, it's oil. That all of that was surging last night.
I
And
just
eventually in real estate,
Mhm.
that benefits real estate over time,
Yeah.
because that is real estate's a real asset. There's a flight to real assets, and people still need a place to live.
Yeah.
Concern is, does something tip us over into a recession if actual serious war breaks out,
Mhm.
and you see energy spike and it breaks something,
Yeah.
and Federal Reserve's got rates too high, and you could see a cascading effect to cause a recession. That outside of something really extreme, though, I
Mhm.
have a hard time kind of seeing that, just with how robust the U.S. economy is.
Yeah.
But we're in an unprecedented period right now, with nuclear powers.
Yeah. Yeah. And but then you poll the average American, and they'd say their top concern is inflation.
Yeah.
Um,
Yeah.
so it's a little bit of a mismatch between
But it could be
perception of what's going on.
it could be inflationary, because
Yeah.
if
Oh,
again,
yeah.
if oil
Yeah.
spikes
Oh,
up,
that's a good point. Yeah.
but then it's complicated, and we're getting off on a ledge of being too speculative. But
Well, that's a good lead into
it's
this.
a great reason to subscribe to the Great Report newsletter.
That's right. We're on top of it. On top of all the speculations, including, if I can segue into this Vanguard, there it is a pure speculation, not even a prediction. They're just warning that, yeah, sure, 10-year treasuries could jump back to 5%. They risk a jump back to 5%. They were hovering, and to put this into context a little bit, they were hovering around 4.3 for a good portion of 2024.
Yeah.
But really, since the beginning of April, 10-year treasury yields have jumped around 4.6. And that's about where it was in early November of last year. So are we on the way to 5%? I think the 10-year treasury yield is subject to market forces. But my big question, and I've said this before, is like, what is these market forces responding to? You talked about the wars, and that would lead me to think that they were buying more.
Yeah, take yield down.
But again, so the quote here is, it's from an expert. He's the international head of international rates at Vanguard, and he says, well, and this is
He's the head of
paraphrasing.
rates. I guess he's an expert.
The investors had piled into treasuries late last year, betting on a swift easing cycle, but incoming data has pointed to persistent strength in the U.S. economy, and so the market has turned against them. And the expert says, even a small move higher in the treasury market past the critical 4.5% level could force investors to abandon their bets on a rally, giving way to a wave of selling that could push yields towards the highs of 2007. We still think that there's a residual long position left over. If that doesn't manage to be orderly squared away, that disorderly move could be what it takes to get us eventually to 5%.
We already brushed 5% at the end of last year. So I mean, sure, maybe all that could be the case. We already hit. I don't know what he's talking about for 2007. We hit 4.99% of the 10-year treasury in November, right?
Yeah.
So it's like we're just going back.
Well, that was on the way down.
Months.
November
the
was on the
10-year
way
treasury
down.
never exceeded 5%.
Yeah. It peaked, I think, around in October, and then the last time it was 4.6. It was on its way down from that peak. Yeah,
correct. So yeah, but maybe I think most of it's none of it's a straightforward answer. I think it's a head fake. We go up, then we go down, but then we're also going to be relatively elevated. It's like a non-binary and also indeterminate.
Yeah, it seemed like the idea was like, well, yeah, if it hits 4.75, then it could go to 5. Well, yeah, I guess it could do that, but it also could not.
Yeah.
And there's little in this article. You can read it if you'd like. But there's little in this article that says how likely this outcome is. We are not in this. We're right now. We're in this not quite excellent point in the economy, but it's still decent. Employment's fairly low. Inflation isn't crazy high, but still a little elevated. Interest rates themselves are a big obstacle, but nothing would lead one to expect that that interest rates would be jumping up so dramatically as to get to 5%. And if it does, I can't see it staying there. I know we just finished talking about how the Fed is trying to get people to stop expecting rate cuts, but there is going to be that is an eventuality. It's just something that you shouldn't, bank today about. So I think that if we're speculating here, the question is what's more likely, an economy getting hotter and hotter that leads to higher inflation, maybe an interest rate increase from the Federal Reserve, or alternatively, something a little cooler, something like just what we've experienced in 2021, bumpiness. That's if the trends of 2024 stay the same as they have been for the past 4 months, then it could be quite a stretch to think that the Fed would raise rates or that the 10-year Treasury market would get so scared as to get the rates up to 5%. I don't even. That's the question. I'd love to know what is the thought process behind people selling their treasuries, and what would the psychological, the kind of assumptions that people would carry to move that 10-year Treasury to 5%. What would the market be thinking?
Why would somebody be selling selling their treasuries?
Mm-hmm.
I mean, if they thought that rates are gonna go up, they'd want to get out now and sell it before prices go down.
Mm-hmm. And it also, what would they? So they would think that rates will go up. Is it in any way a statement on the economy? So are they? Because
could be.
Okay.
I mean, it could be bullish because it could mean that we're going to be seeing higher inflation.
Yeah,
we're going to be seeing growth. Maybe I want to get out of bonds, put it into equities.
Okay. That makes a little more sense then. So, and that's another thing too. It's like,
or they're really scared and they just go to cash, which if they're inflation, maybe not a great idea, besides the idea of having enough dry powder to take advantage of some dislocation in the market.
Okay. Yeah. And so none of those assumptions really would line up with the conditions that we're seeing right now. I think you got to have some special thing that happens to trigger that. Although, it's been unreasonable before. And I'm trying to think back to
the idea, if people are convinced that, okay, inflation isn't going away, that would be the reason whether it is actually happening or not. Yeah. I mean, the economy is hot. I mean, we were getting ahead of ourselves a little bit, Matt, but we're seeing a recovery in rent growth after some declines at the same time. So demand's like in the apartment market is like incredible right now.
Yep.
And it's happening at this, and good thing it is.
Yeah.
Because at the same time, and I'm going to just pull up this graph, we're making records every single quarter.
Yeah.
For apartment completions. I mean, look at this graph, Matt, for Q1 of 2024. Absolutely smash pass. We're like, almost at 140,000 units completed. Going back to 2018, we were at like, 80 some thousands, 60,000 per unit. This is so many apartments that are being delivered. Again, it's concentrated in a handful of markets, but there's a lot of apartments coming online everywhere. Rent growth is positive right now.
Yeah.
Like just barely, but it's actually positive. In the face of all this new supply, obviously, it's hard to buy a home. You can't get a mortgage. People are renting. People are renting longer. Wages are increasing. Wages have been increasing now for longer than 6 months. Jay Parsons was saying, and Carl Whitaker have been saying this also, if this wage growth continues, which it is expected to, we're actually going to kind of make up. Wages are going to make up for all of the rent growth that we saw in 2020 and 2021. And that's incredible.
Yeah.
And so rents are going to be able to grow a little bit more. But all this means that we're going to see a little bit more growth in inflation. And so it's like, maybe we're going to be at 2, maybe we're going to be at a little bit more than 2. This is all really good for apartments. It means that interest rates are going to be definitely higher than they were like the last decade. But there's also no reason to believe that they should be so much higher, than they have been historically.
Yeah.
And probably somewhere in the middle between where they were in the 90s and when they were the last decade.
Yeah. Yeah.
So
that makes sense. And yet to continue on your points that you were making about the multifamily market and to return to some of your comments you made earlier about, equity may be a little bit scared of rates. But
equity's always scared.
And rightfully so. It's
rightfully
their money.
So. It's equity. You can lose it.
Yeah,
you should.
But owners, operators, syndicators that have seen the positive signs of rent growth, the positive signs of people that are following the rent growth and demand picture for 2024 would be a lot more confident. If that's all you were looking at, you'd be very confident in the apartment market, because not only do we've got so much supply that came in the first quarter of 2024. but we also have an incredible amount of demand that's right up against that. So in 2023, one of the reasons why we had low stagnant rent growth is because the demand was less than the supply. Well, that gap between demand and supply is closing and getting smaller and smaller.
Even as the supply is increasing.
Even as the supply is increasing. And that is just incredible. And it is, and because also apartment syndicators, owners, whatever, they're not idiots. They know that the permits,
not all of them.
Not all of them. All of our, let's just limit to Gray Report listeners. They are geniuses, and they know in 2 years, 1.5 years, the apartment supply situation is going to be much different, but demand is probably going to continue to be strong.
Yeah, no, I mean, so I think I mentioned, man, I was at this conference, mostly institutional investors up in Chicago this week, and everybody's bullish on multifamily.
Yeah.
Very, 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 very bullish. And there's a lot of things that, I mean, people didn't even want to talk about office. I mean, like literally, I don't even want to mention. I mean, besides mentioning how bad office is doing and it's uncertain, which I think that could be not for me, but like, I think somebody's going to make a lot of money on buying an office building for like nothing, like getting it for free. And then someone's like, I actually do need some space. I can pay this super cheap, lease. And then, all of a sudden, again, I think the pendulum shifts back and forth. I mean, we revert, and I don't think that everyone's going to work from home forever, and not every office building is going to become irrelevant. Some will, but there's a price where it makes sense, and just nobody wants anything to do with office right now. And people are going to be giving them away. Again, not for me, but I think somebody's going to make a lot of money with office.
Yeah, because it does seem like there's going to be a point where people are like, oh, they think that half of all offices are going to go away, but really it's probably 10, 20%, and maybe not even that. There's
or it is 50%, but people are thinking that like 90% is going away. I think that's actually it's like 80% of the office market is just going to go away. But the reality, maybe it's 50 or maybe it's 40%. But it's not as much as people think. I think people are over. People always move too far one direction and then it has to come back in. And I think we're kind of at this point where we're kind of over those lines, like the RSI, it's like, it's okay. We're above that 70 range. We're in the 80. At some point, it's gotta come back down here to kind of get into a little bit of a sweeter spot. And
if you are a subscriber to the Gray Report newsletter, which is at www.graycapitalllc.com/newsletter, you can subscribe for free. This week, there was an office market report that did show, at least it seems like the bleeding has stopped. Office performance is not continuing to degrade and maybe improving slightly. So maybe they kind of hit bottom, and they're going to avoid like complete catastrophe. I do think these are huge buildings, enormous and valuable assets that someone could really pick up for really cheap.
The right buyer in the right market, the right place. I think so. Again, not everyone, but again, there is a price where it makes sense. I mean, and maybe it's like, okay, this is worth less than the dirt that it's sitting. All right, maybe you can put I don't know. You make something fun. So we talked about demand.
That was some supply. Sorry, and I wanted to pair. I know
we talked about supply.
Wanted to pair it with another Real Page article about demand that was it's about a week before the supply one, and it's just really useful comparisons here between apartment demand in first quarter 2024 and the typical Q1 apartment demand, which is an important context. And the level of demand in this first quarter of 2024 was such that it actually turned a below average year for demand. Now, this is apartment absorption that they're using. A below average year for demand just from Q1, it took it to 20% ahead of a typical annual absorption rate from the 2010s. So
almost double.
Yeah. It definitely doubled from the previous quarter. And Q1 is usually you don't see as much absorption compared to the other quarters, but this Q1 was a real blockbuster one. Now, it wasn't the most in demand Q1 ever, but it was certainly among the top ones. If you kind of have to cut out the first Q1 of 2021 and stuff, but it's hard to. I don't even know if there is other than. I can't find a Q1 that's as that shows as much significant apartment demand as
no, it's best. It's the strongest demand in almost a decade, man.
that is crazy. In another context of
Hashtag facts.
yeah, all right,
Or
good.
no cap.
I had to think about that, but yeah, wow. And we did talk about supply, which is important, and that's why I wanted to follow it up because the real context of this, not necessarily, is like, oh, no, let's compare to the averages in history. Really, it is huge demand and huge supply. That's the story. And for all the discussion about high supply and Sunbelt market, the demand is there too.
Yeah. Yeah.
And
Yeah.
it's not. Yes, it is being overshadowed by the supply right now, but it's not falling off. And I think it means these
Can I
markets
ask
have
you a
legs.
question, Matt?
Yeah.
Okay, so do you think so? Demand is increasing. We've got a good trend there. Any reason to believe that demand's going to fall off anytime soon?
I don't think so.
So we know that supply is going to start coming down closer to a trickle, kind of back to 2018 levels ish, or less, or it could be depending on if you're looking at Real Page or Yardi. Yardi's got a little bit higher deliveries. Real Page's got a little bit less. But if demand even just stays where it's at right now,
yeah,
going to be an environment where there's a lot of demand, but that supply's come down, and that absorption is going to really spike.
Yeah,
it's going to be really strong when that translates into rent growth. And so again, going back to the beginning of the conversation, we've got some interesting growth prospects in front of us, but now there's this fog of war. People aren't sure to make decisions, and assets are being sold for the price or less than the value of the debt on these assets. People aren't sure. The price per unit are way below construction costs, but people are looking at treasuries moving around, and it's short term challenges with like major long term opportunities.
Yeah,
and so you hear in like especially the single family home market, like you don't marry the house, date the rate or something like that. And you got to take your financing capital markets into account for sure.
Yeah.
But I think there is a, kind of growing realization that, these assets are the prices on these assets are starting to become attractive, and only looking through a lens of higher rates forever, not longer, higher rates forever and subdued growth. Looking at the growth rates of last year. So like, we're not going to look at any growth and higher rates. Yeah, you can't make sense of it. But, if you are playing the game, trying to see 2 or 3 moves ahead on the chessboard rather than just one move right now.
Yeah.
I think that opportunity crystallizes a little bit better. That's the way I see it.
Yeah. Yeah. No, I think that it is. Again, it's going to be really interesting because the job isn't necessarily fighting against other syndicators. Maybe it is going to be convincing equity that of your commitment and your confidence in whether it's a given market or a given project, or really the multifamily market as a whole. It made me more comforted, I guess you could say, to even see that these Sunbelt markets or these popular markets that have been suffering so much with slower rent growth, or their performance have been suffering. If you're a renter, that's great. But places like Dallas, Austin, Las Vegas, even Seattle, saw a great deal of apartment demand, increased absorption, and it says to me that like, okay, even those the supply is maybe a temporary thing, but this demand is probably going to be a little stickier. I also now, when it comes to supply, they did have in that article earlier, and they took it out of the article from between last night and this morning. They had a chart of starts too.
Yeah.
And not all of the starts were below average. It's not like these high rates are quashing starts in every single market, because in Indianapolis there was actually above average starts. And maybe in some of these other Midwestern markets, actually, you'll see this, and we referenced the cycle of apartment development. Now, I think that in the Sunbelt markets I was just referencing, there are big swings, right? Phoenix, you can get overbuilt or underbuilt. And if we remember the seminal work of Noah Stone and Jonathan Rappa when they were at Berkadia, talking about low beta and high beta markets in some markets where, okay, the volatility swings to the upside more than the downside. You have to kind of factor that in. But the Midwestern markets are a little, maybe lower beta, a little more stable, a little less volatile. And they've been pretty strong. So I think that they may not have that period where they get overbuilt and then underbuilt and overbuilt and underbuilt. But a market like maybe Phoenix, I said this was talking to someone last fall during one of our multifamily meetups is they were like, oh, that's an interesting market. If you can get it when things are cheap right now, then you could really get some growth because yeah, it's way easier to be confident about longer term demand than any decisions of apartment supply, which is necessarily going to be responding to that demand. And
Basically being a swing trader.
yeah, oh yeah, and I also remember, Jay, he worked in student housing. He was like, well, yeah, a lot of times the way that student housing works sometimes is like developers will go in, they'll build up in one student housing market, they'll build up a lot of new apartments, and then they'll go to the next one, and then and sometimes you see that in the apartment market, I think too. It's
Yeah.
definitely
Yeah.
an analogy there, but again, I think that the apartment demand swing, it they've got legs. Austin, yeah, sure, it's got a lot of new supply, but it's not going anywhere soon. And
Yeah,
yeah,
they got another big announcement. Major manufacturer. I forget exactly what it is.
mhm,
But yeah, no, these markets, they are challenged in the short term, long term opportunities.
mhm,
Absolutely, I think there's still going to be crowded
yeah,
trades.
yeah,
And people just paid stupid money. And that's the thing. It's like,
mhm,
yeah, good market if you could get a relatively reasonable price
yeah,
for something, but
yeah,
people were just paying prices that had all of the upside baked in.
mhm,
I mean, just there was no more up. It was priced to absolute perfection,
yeah,
and things didn't work out perfectly. So
yeah. I think I think that your analogy at the beginning, so the window's propped open, I think that that's really apt right now because what what we're seeing is not necessarily people getting wholly scared of the market. They're not running away from it. And it's hard it's hard not to see the signs of a real recovery and a much more positive year for the multifamily market compared to last year.
yeah.
And I'm just imagining our investor team, talking to potential investors and making a really easy sale because we're so confident we have some of the numbers behind it. And so that's an easier lift to me than fighting against a bunch of other operators that have the same idea.
It's mostly just because we just don't overpay for things.
Yeah,
I mean,
yeah.
I think that's kind of comes down to it is like we're a group that, um, like we're not known as somebody who's gonna like be the highest bidder, but
Mhm.
like we're known as a group that closes
Yeah.
and like, okay, if they say they're gonna do the deal, they're gonna do it.
Mhm.
Like, and we do. We've never not closed on a deal that we've been under contract on.
Yeah.
Ever not been able to raise the money. And we just raised $17 million in this environment. I
Yeah.
mean, that's not a insignificant amount. And we
Mhm.
did it without, true institutional capital, a lot of quasi-institutional, some registered investment advisors, family offices.
You could correct me. I think this is the most individual investors that we've had on a
Yeah, the
deal.
most number of investors.
Yeah.
We've done a larger raise in the past, but we had 76 investors,
Yeah.
76 LPs. 50% were new
Mhm.
investors, 50% were recurring investors.
Mhm.
The average investment for new investors was 150,000.
All right.
Average investment for existing investors was like 360. And I think that put the average like right around 250.
Okay.
So that was, but our close rate, actually was pretty surprisingly high. I mean, we had to have a
Yeah.
lot of conversations, but a lot of the folks that we had conversations with, ended up doing the project.
Mhm.
Um, I think people have watched us, some of the decisions that we've made over the last kind of 2 years of, staying disciplined and
Yeah.
not getting into kind of hot, troubled waters.
Mhm.
Deals are doing pretty good. And then also I think the deal spoke for itself.
Yeah.
And then, yeah, I think that the team, does a good job of presenting it, but I think really the deal spoke for itself. The basis we were getting, the returns and, the assumptions weren't too crazy either.
Yeah.
Honestly, wasn't a whole lot of, pushback on our assumptions. I think even
Mhm.
people said, I think you guys get more aggressive on it. And we're like, we don't need to.
Yep.
But, yeah, you just got to keep buying right because
Yeah. Yeah.
they say, and it's not 100% true, but you make your money in real estate on the buy. I've seen that happen. I've seen that not happen.
Mhm.
But certainly basis is very powerful.
Yeah. Yeah. And
Because that's what matters at the end of the day when you sell it.
yeah, I agree. This was a really exciting week for sure.
Yeah,
And
and it's going to be another. I mean, we're going to learn more in the over this next week.
Mhm.
Again, what's happening in the Middle East, not like an absolute direct relation to what's ever happening in the United States multifamily market, but there are some uncertainties.
Yeah.
that creep in to when major investors, institutions are thinking about writing big checks.
Mm.
And if you got somebody who's a little paranoid and thinking about World War III is going to break out next week,
Yeah.
maybe you don't write that check before you're not going to close for another 90 days.
Yeah.
So let's navigate this fog of war together. We're going to be in it together every step of the way. Make sure you're subscribed to this channel. Give us a comment. Let us know your thoughts down below. And then hop over to graycapitalllc.com to learn more about the firm and sign up for our newsletter. So all these articles and even more and even better ones that we show right there. And we send you all kinds of good stuff. You'll hear about the deals. It'll all be good. So thanks for watching. See you next week.